Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show, Raymond Chan gives us the three stocks the broking firm Morgans likes. Gemma Dale from NabTrade pinpoints the stocks in and out with the huge number of traders on the online broker's website. I show you an excerpt from my podcast with Bitcoin expert Jeremy Ying from the cryptocurrency trading platform Gemini. He tells you why you should believe in Bitcoin and its future price going higher and higher. Then Paul Rickard and I will look at Jeremy's Bitcoin views, and Paul will look at the demerger of Woolies and Endeavour drinks. How come few really wanted to pop the champagne corks to celebrate with Endeavour on its first day on the stock market? And finally, Ying Yi Ann Cheng of the Switzer High Yield Fund gives us her take on what will happen to interest rates in a very, very unusual environment. Should we be scared? So let's kick off with Raymond Chan from Morgans. Well, joining me now is Raymond Chan from Morgans. How are you, Raymond?
Pretty good, Peter. Thanks for the invitation.
My pleasure. Let's just talk about the three big issues that you think are going to dictate stock prices in coming months.
Yeah, I would like to provide an update. Maybe I would like to add another one as well. But the three key issues always on my mind from the beginning of the year is the pace of the vaccine rollout. The number two is the bond yield. The number three is a ESG. And Peter, if I need to add a fourth one, it will be the upcoming August reporting season.
Yeah, they're all really important. Do you think at the moment the problems with the vaccine rollout haven't really hurt the stock market at this point in time?
I think in terms of, on a global scale, we are not doing too badly. The percentage of the population got the first dose is already over 20%. Of course, it's far, behind what the government originally planned, to have a herd immunity by the end of the year. However, as compared with other countries, we're not doing too badly. However, there's certainly, with only just 20% of the population so far got the first dose, that will result in a lot of business interruption, like how we are, in Sydney at the moment. There will be continue to be restriction and sometimes lockdown that hurt the business in a big way. But I guess, Peter, what happened also at the moment is last time we talked about the bond yield stop rising, because since the beginning of the year, we see a sharp rise in the bond yield. In about April, it stopped rising. But what happened between April and now, the bond yield actually start falling. That certainly assists the stock market valuation at the moment.
And it's helped tech stocks in particular, hasn't it, mate?
It's certainly be the case.
Yeah. It's interesting you throw the ESG, that's environmental, social, and governance. Are you saying that because the community cares more about these issues, therefore various stock prices are either gaining or losing because of their, I guess, the scorecard, the ESG scorecard?
It become very prominent now. Since the beginning of the year, we continue to see a lot of fund flow going into the ESG fund or the sustainability fund. And the fund flow, yes, I agree, will impact the choice of stocks, and that result in outperformance of a particular stock which has a ESG focus, and the underperformance of stocks like AGL, Origin, or coal stocks where they score very poorly in the ESG space.
Yeah, on the subject of that, let's look at Woolworths and their upcoming demerger. Would you expect Woolworths' share price to actually gain because they get rid of their alcohol and gambling assets into the Endeavour Drinks company?
This is a very, very good question, Peter. Of course, on the day of the demerger, the Woolworths share price will fall on the value of the Endeavour business. However, in the medium term, what we're seeing now is Woolworth will have a very strong balance sheet without Endeavour. The way the supermarket work at the moment, they will have to continue to invest a lot of capex to maintain the competitiveness. To be honest, I think, as a group, they may do better, but, no one doubt, in the new world of the focus of the ESG, the gaming side, the alcoholic side will have to be spin off to attract more fund flow into the mothership, if I would, the better way to put it, into the Woolworth.
Yeah.
So I think in medium terms, I think Woolworth will continue to be well supported.
Yeah. So it seems to me, mate, that the share price has to fall because you're taking out the gambling and alcohol assets. But then at some point in time, the market, fund managers will say, Woolworths is now more viable if I'm an ethical fund, and that should lead to the price going up. So probably waiting for the demerger to buy Woolworths seems like a more sensible strategy. And this is not financial advice, it's just our best guess.
Yeah, I do agree with you, Peter. The other thing, we talk about spin-off. There has been a number of spin-off in Australian history, but I would not forgot about Endeavour as a spin-off business, because history suggests many of these spin-off turn out doing really, really well. Yes, the ESG is loud and clear at the moment, but being a more nimble and smaller business, in fact, they may attract the attention of, the like of private equity. They may, want to do something about them. Yeah.
And also let's say this, in Australia, there are a few people who like gambling and drinking, but we won't dwell on that. Okay, let's go to the stocks you like. You like Westpac. Tell us why.
Just an update on the Westpac. I think the May result was pretty good. It's well above the market expectation. Continue to pay around 5% dividend yield. For investors who want income stocks, I think Westpac continue to be to deserve a place in the portfolio. And what interesting lately, it's not going to fundamentally change Westpac, but I like the way they do it, is they introduce what they call a 3% saving account for the young people. So essentially what I mean is if you are aged between 18 and 29, and if you open an online Westpac saving account, and if you meet a number of their conditions, such as the number of transactions that you make in that account, you can earn up to 3%. For me, I think this is a good way for them to, trace the younger market, because obviously the major banks are trailing, as compared with the fintech player. So far so good. Westpac continue. I continue to suggest Westpac is not buying for growth, but for the defensive yield, I think it's pretty good.
Okay. Computershare. Now it's had a big run, but you still like it with upside?
Yeah, I think so, because Computershare initially it got locked down because they acquired the Wells Fargo corporate trust business. Now it bounced back because I would see Computershare as an interesting stock as an inflation hedge. A lot of people talk about inflation nowadays, but I think Computershare is one of the few that can actually leverage on the upside of rising interest rate. The easy way to explain is Computershare hold a lot of customer deposit cash upfront to perform its services. So they are all invested in the short-term bond. However, when the interest rate is so low at the moment, they don't earn much. But imagine in the future, if the interest rate continue to go back up because of inflation, they will earn more money. So I think Computershare deserve a consideration for someone with the growth oriented mind. Remember, the PE is not too low, but certainly not too high, around 22 times at the moment. The yield is around 2.8% projected.
Okay. And what about NXT? This is a company I like. It hasn't really, but it never does spike at the same time as other companies. It seems to go up, plateau for a while, then go up again. What's your view on NXT?
I think it's all eye on upcoming, how many of the option contract being exercised over the next 3 months, because those contracts being issued to a number of big players like Google, Salesforce. about close to a bit over 12 months already. And those options will have to be exercised within around the next 3 months. So, and it's interesting, usually June is the time when NXT announce new contract win. So I think a lot of that may got delayed and that may impact the share price. But if we see some contract win, that will be, I guess, a catalyst for NXT to move into the next level.
Yeah. So you're betting that they will come with some good news at reporting time, and we'll see something impressive share price wise. All right, mate. One last thing. You guys are associated with an IPO for Cobram Estate, and a lot of us use Cobram Estate olive oil. When is this expected to list, and what's your view on the company?
Well, early days at the moment, and I'm afraid I cannot talk too much at the moment, but certainly, a lot of customers, it's a household name, a lot of people using it. Yeah. So I'd be interested to learn a little bit more, but it's just that at this stage, I'm not able to comment on it.
Okay.
It's very...
But do you know the expected date of the listing?
No, it's very preliminary at the moment.
Okay. Hasn't been
I'm not sure if I can talk about this at this stage. Yeah.
Okay, right. Yeah. I put you on the spot, mate, but that's my job. Great to talk to you, Raymond.
Thank you, Peter. Much appreciated for the time.
Pleasure. Raymond Chan from Morgans. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, we're catching up with Gemma Dale from NAB Trade. We'd like to see what stocks are doing really well and which ones are out of favour. Good to see you, Gemma.
Nice to see you too.
Now, this is probably a hard question because it's far too early, but today Woolworths lost its drinks business, and they both went their separate ways. Have you had a chance to see what the NAB Trade customers have done in relation to Woolworths and Endeavour Drinks?
Look, they won't have a particularly strong view unless there's a really strong movement in the price. We have a really contrarian base. They do love to pick up favoured stocks at a discount. So if the prices fall away really dramatically, we see a huge uplift. When Coles was hit last week over 4%, we had a 94% buy on Coles. It's a stock that people like, and they will leap on it if it's sold off. 4% is great. That's enough of a discount for people to get really interested. If it's in the 0.5% range, we won't see huge volumes. People are not that excited if it's not that big.
Well, I think you know how many times I've written for NAB Trade's website, buy quality companies, buy the dip on quality companies. I think a lot of people believe that is not a bad investment strategy.
Honestly, the idea that retail investors panic when prices fall is just clearly not borne out in the evidence anymore. People completely understand the concept of buying the dip. They are very enthusiastic to buy quality companies. We have seen a really, really strong shift to quality over the last 3 months, let's say, 3 to 6 months. There's been a real shift in buying behavior. Last year, it was just incredibly opportunistic, and there was an appetite for everything. Everything was sold off last year, obviously, but an appetite for things that had huge growth potential or got hit particularly hard. Yeah. Whereas this year, it is generally only the high quality stuff that they will go for if it does get sold off. It's quite interesting to see the change in behavior.
Yeah. So 3 months ago, tech stocks copped it when the bond market was suggesting higher interest rates. We've seen a little bit of a comeback for tech stocks. Have you seen what tech stocks are back in favour?
So interestingly enough, tech has not been a huge part of the portfolio for a lot of our investors anyway. Afterpay is the big one. They've loved that for a long time. And Afterpay was one of the most bought stocks last year, right? So people absolutely loved it. And it was down below $10. That was so exciting. A lot of them rode it all the way through. So they were not trimming despite extraordinary prices. Went all the way to $160, came back. Because it's bounced around so much, they're really learning what's a decent level for Afterpay now. So when it was around the $85 mark the other day, we saw buying. When it was getting up closer to $100, we started seeing trimming. When it was up around 120, they were definitely trimming because they're like, we don't think we're going to get to 160 again. Most of them are sitting on massive profit. So the average buy price for Afterpay last year was $40. If you're selling at 100, even though you missed the 160, you've done very well. So it's very mixed. A lot of people have held it for a long time and they are taking profits. At this particular point in time, because it's so close to the end of the financial year, there's a lot of capital gains tax management and people tax loss selling and that sort of stuff and repositioning their portfolios, which would not necessarily be typical at another time of year. So Zip is also similar. When it has a big bounce, people are all over it. The others have fallen away. Xero's not that big at the moment. Appen has bounced around at a relatively low level. Nuix has obviously been absolutely hammered. It's halved in value since it listed. That has not been enough to attract our investors. So there's not aggressive discount hunting if people are concerned about the outlook. We're just seeing more tax management and profit taking if people feel that that they've done very well.
Have you seen any stock sold off this month where you've said to yourself, that's probably people taking their losses and at an appropriate time we'll probably buy back in next financial year?
Oh, interestingly, we've seen people taking profits in that situation. The big one was the banks. So we've seen a lot of profit taking in the banks over the last couple of weeks. They were again bought incredibly aggressively last year. All big four of the banks were in our top 10, in our top 5. Really, people loved them at such a massive discount last year. When CBA was over $100, people were just astonished by that and very happy to trim. CBA is the stock that our investors would love to hold, and they never feel like they get a good enough discount to buy it. It doesn't get hammered the way the others have. And so they just haven't had that opportunity to buy it, but they were trimming over 100. Interestingly enough, they were buying when it was below 100 the other day. So at $99, they're like, great, I'm going to get in. They see that as a 5% upside in the short term, I guess. But it's interesting. Banks were the ones that have definitely been trimmed. And you would assume that is both an assumption that they are close to their peak for now, and also pre-30 June, I've done very well. I've held for more than 12 months in most cases, and so I get the discount and I'm happy to take some off the table.
What about a company like A2 Milk? Was a darling, has had a shocker this year. I would have thought there'd be a lot of people saying, let's sell it, take the loss and use it against my capital gain. But A2 Milk has actually been on the rise over the last few weeks.
So it's been really, really interesting. It's fascinating you brought that one up. I mean, they had 4 downgrades in less than 12 months. That's damning for any company and very difficult for investors to stomach. It was extremely popular with our investors a couple of years ago. So prior to the wax stocks, it was all about miners and milk, and A2 Milk was the head of those in terms of the one where there was most interest. We've seen buying, but it's been fairly modest, not widespread. And it's been people sort of nibbling away at it over the last few months when it was at its lows. And then it's been coming back. We haven't seen massive profit taking in it because they haven't held it long enough in most cases, but there's been some buying, a little bit.
Okay. Any other surprising stock development that you'd like to share with us?
Look, the big one that is interesting to observe, so the two that were both very high conviction holds and not held by a particularly wide group of people that have really come into our book in the last 6 months have been Fortescue and CSL. So Fortescue is our most traded stock by an enormous margin at the moment. The iron ore price is so high. Predictions that it'll come off just don't come to fruition anytime within the time frame people have been predicting it. So a lot of our investors have been making hay while the sun shines with Fortescue and doing incredibly well out of it. And it's much more widely held than it used to be. So the volumes are absolutely massive, but it's quite well traded. People are watching the iron ore price overnight, having a view on what's going to happen during the week and trading it. The other one is CSL. So it was down around $250. People got a nibble at that COVID low again this year. And so a lot of people missed the low last year. When the price came off again at the beginning of this year, they were able to have another crack at it, and our base bought much more CSL. So we suddenly saw a lot of CSL. Over $300 they were selling. It was under $300 they're buying again. So it is a stock that they're keen to buy. They will trim above 300, it looks like, but below that it's buy for our investors.
Right. Gemma, one last question before you go. Because you have this bird's eye view, and I use the bird not in any
Helicopter view? She'll call it helicopter view.
I don't want to be misinterpreted. But given your advantaged view you have, is there any company that you think, because of the interesting buying, may well have a good future ahead, at least in terms of the people on NAB trade who buy stocks?
Oh, that's such a good question. Look, honestly, our investors have a very impressive ability to pick what's going to do well over the next 3 to 6 months. As I said, the two stocks that have come in more recently are CSL and Fortescue. CSL, the outlook, we're expecting a pretty awful second half, but it has been flagged. So perhaps our investors are looking past that and going, it's still well off its highs. Its highs were around $350, so they can see about 20% upside in that. Maybe that's where they want to be.
Okay, I was trying to get the stock that you went home to your husband and said, hey, we're going to buy this one, but don't tell anybody, particularly Switzer.
We'll be very quiet about that one.
That's right. We'll never do that. Gemma Dale, thanks for joining us.
Lovely to see you.
I want to talk to you about the Switzer Golden Ticket promotion. Yes, our marketing department has been working overtime to come up with something great, and I think this is great. How would you like to win a free 1-year subscription to the Switzer report with all the great stock tips that the report produces on a weekly basis? Well, we are giving you, our loyal audience, the opportunity to do just that. From now until June 30, with every purchase of my book, Join the Rich Club, which is 50% off until the end of the month, you'll enter your chance to find a golden ticket. Yes, a golden ticket, and you will win a free 1-year subscription to the Switzer report. So if you're a current Switzer report subscriber and you find one of these golden tickets, then we'll just add another 12 months onto your existing subscription for free. How good is that? We've got 5 of these to give away, so get in and good luck. Why is Bitcoin so valuable?
I think, we look at Bitcoin from a few angles, right? Number one, it is the oldest cryptocurrency. It was created back in 2009, right after the financial crisis, and it is the only asset in the world that has a specific limited supply. So for those of you who are not aware, the maximum supply of Bitcoin can only reach 21 million, and it can never mine more Bitcoin. So because of that fact, it is the only asset in the world. Not even gold. I mean, even gold, if you think about it, you can still have about 5 to 8% of annual supply coming to the market. But for Bitcoin, it's a maximum of 21 million. And I think by that fact, it's demand and supply in the basic economics 101. Yep. Anything that has a limited supply has value.
Yeah, exactly. The fact that it is now dividable or divisible on various platforms and people can buy percentages of Bitcoin, has that helped the value of Bitcoin or undermined the value of Bitcoin?
It definitely has helped. Number one, the fact that you can buy in a fraction, it means that it totally democratized, adoption. So whether you have a bank account, you don't have a bank account, whether you're making 100,000 a year or 5,000 a year, you can still have access to Bitcoin as an investment or as a store of value. So I think this really kind of drives a mass adoption, especially into the mass retail market. So for me, it definitely is a positive, and it's also part of the reason how Bitcoin was created. That it is investable in up to 8 decimal places. Unlike if you look at a piece of Tesla, you might like the company, but if you don't have 600 or 700 US dollar, you're not able to own a share of the company.
Tell me this: you've worked in companies like Goldman Sachs, and you clearly understand many aspects of the investing world. Is there any other asset out there that has the volatility of Bitcoin? I can't think of one, but maybe you can.
At the moment, I agree. Volatility on Bitcoin or cryptocurrency as an asset class is high. But I'd like to take a step back, right? Even looking at Bitcoin in particular, just about maybe say 3 years or 5 years ago, the volatility was much higher then. So even though at about 80% volatility, it is considered high, versus the other traditional asset classes like equities or fixed income for that matter. But the fact that it has been slowly declining, I think it is a evidence that there is an increased institutional adoption. So just like in equities, a small cap stock, will have a high volatility than a large cap stock. And even if you look at Amazon in early 2000, it was highly volatile. And in fact, the stock price has fallen 85% from the peak to trough, before becoming the most valuable company in the world. So volatility is one thing that clearly we all recognize, and especially for a young asset class like cryptocurrency, which is after all only about 12 years of history. As they mature, I believe that the volatility will also slowly be reduced.
Do you think that the divisibility has actually added to the volatility? Because if there was just X number of Bitcoin, it would be like X number of Picassos, in a sense, wouldn't it? Or X number of Impressionist paintings. And I've never numbered them, but I would say there's probably 3,000 really valuable Impressionist paintings. And they sit within a price range, depending on whether you like Monet, Manet, or whoever. So Bitcoin, and so it'd be limited to all the people who were prepared to pay those large amounts. But because you've got so many people involved in Bitcoin because of divisibility, do you think that has actually added to the volatility?
Then I would take a step back and to look at the purpose of the creation of Bitcoin. The purpose of the creation of Bitcoin is not for it to be owned by a handful number of investors, but it is for the public, for the people, and even like our mantra as a company, right, Gemini, is to empower the individual. So I think the basis is Bitcoin is for everyone. Now the volatility part is really a separate question altogether. And like I said, I really believe that as the asset class continue to mature, as people start to understand more, they start to read about a white paper, understand exactly the true essence of what Bitcoin means and what the technology means for the future of finance or the future of money, the volatility will slowly come down. Now, if I can also, coming from my traditional banking background, when we look at volatility, we don't look at it in isolation. We always look at it vis-a-vis return. So from a risk-adjusted basis, Bitcoin actually has the best Sharpe ratio. So if you look at the 10-year average return on Bitcoin, is close to 200% compared to the 10-year average return on S&P 500 global equity is about 9%. So volatility might not be a bad thing in that regard.
Yeah, but Jeremy, the people who bought in at 54,000 today would be thinking, hang on, at 32, whatever it is today, that's a big jump. It's a big drop, and we don't know whether it's going to go back to 54 soon, or if the Chinese government might get involved and push it down even further. This is a very tricky asset, and as you can see, I'm not being critical of its existence, but I just think it's a very dangerous plaything, and I should put this all in perspective that 4 or 5 years ago in my Sky Business program, I had an owner of a hotel in Woolloomooloo in Sydney, and a backpacker paid him a Bitcoin for the night, and Bitcoin then was worth $329. And I remember that, quite dramatically, because as I watched the price go, I realized that this hotel owner probably didn't need to keep being a hotel owner if he was accepting lots of Bitcoin in those days at $329. And so, all right, so, okay, let's accept that. I've got a number of questions from investors who watch my show, and here's some of the questions that I'd love you to have a crack at. Well, sure. First question, Bitcoin in a range of 30,000 to 42,000 US dollars. where do you see the direction going? This question doesn't come with a time frame, but let's just say over the course of this year, what's your best guess of where you think the value of Bitcoin will go? And be right, Jeremy, of course.
Well, purely my personal view. Obviously, Gemini doesn't provide a price target or research or investment advice. Now, I can't tell you where the bottom is. I don't think anybody could. So when I look at Bitcoin in particular, I take a 4 or 5 years investment horizon. Now, whether are we going to see lower or higher in the next 1 month, I can't tell you. But I'm confident that in the next few years down the road, it will be higher than where the price is right now. So from an investment standpoint, I think the price point right now is a good level for accumulation. And again, you're right that this asset class is highly volatile. So the way that I would suggest an investor kind of go about thinking of allocation to crypto is from a portfolio construction standpoint. Just like you don't put in 100% equities, you don't put in 100% into crypto as well. You could start with an allocation of say 3 to 5%. Don't take leverage, putting the amount of money that you are able to hold long term, and stick to your conviction on the tokens that you have understood the technology, understood the protocol, understood the engineering team that's behind it. And for Bitcoin, obviously understanding exactly what it means and brings. And I would then sit on it and hold on for long term and wait for it to appreciate.
Okay. The actions of the Chinese government, specifically against Bitcoin, how lasting will the effect be, do you think, on the value of Bitcoin?
I think that's a very good question. And clearly, the price action that we've seen in fact, over the last 24 hours, a lot of it is primarily driven by the negative news flow that's coming out from China. If we remember back in 2017, China has also banned crypto trading. And in fact, some of the crypto exchanges in China actually has shut down, while some of the others have left and moved away to be conducted the business offshore. So did the market crash and stay down? I think we all remember, right? What happened is that yes, over the next couple of years, there was a period of time where Bitcoin was trading, below 10,000, but since the end of last year, it has recovered and even went to all-time high. So I don't think one country's action is able to destroy this market. Bitcoin is bigger than that. I mean, on one hand, China is banning crypto, but on the other hand, you have El Salvador establishing Bitcoin as a legal tender and allowing it to be recognized as a currency, official currency. So I would say that so my money is that this would not have a severe and lasting impact on the price of Bitcoin. The value of Bitcoin is more than essentially it's decentralized. It is peer-to-peer. So that is my long way to answer your question.
Jeremy, thanks for joining us on the program.
Thank you very much. Have a good day.
Yeah, same to you. Well, I thought I'd talk to poor Rickard about that interview I did with Jeremy Ying. Have you changed your attitude towards Bitcoin, or is it still a bit like gold to you? You're just not prepared to give a punt?
Peter, I haven't. I found what he had to say pretty interesting. But look, boil it down. Okay, sure, the first cryptocurrency, it's divisible. They're all good positives. It's got a finite amount of 21 million Bitcoins. Well, yeah, that's, I guess, from a supply and demand argument, that's good, but that doesn't mean the price has to go up or will continue to go up, or it should be even at $34,000 US. I tend to think with the cryptocurrencies that the people they're very passionate people, Peter, and they're a bit like the gold bulls. They're always one-sided. And what doesn't convince me about Bitcoin is the following. First of all, it's not hard to replicate with other cryptocurrencies. Now, Bitcoin's the best accepted, it's the first, we all know that. but this technology in some cases is probably looking a little bit old, right? Secondly, it's very environmentally unfriendly, right? The cost of mining this is just, a lot of the young people buying Bitcoin say how green they are, right? I mean, this is crazy stuff in terms of energy consumption.
But Jeremy did actually make the point that is actually not absolutely correct, Paul. I think you've said that 80% of it is on renewables. And I think that's why Elon Musk has turned around his view on this.
Yeah, I mean, 80% on renewables. Those renewables could be used to reduce, so we didn't have to have so many coal-fired power stations in China, right? I mean, like,
I think he might be a cynical baby builder.
I think he's a bit of a, but everyone likes to tell you how green they are. And then look, the other problem, of course, you have to be honest about Bitcoin. It's used by criminals, right? That's how, if you get a ransomware demand, you're paying Bitcoin, right? The drug cartels, when they're transporting money around the globe, are using Bitcoin, right?
You know a fair bit about this criminal behaviour.
I do, because I've seen ransomware attacks, and they're all payment by Bitcoin. So you can't get us. No matter how you believe in this is great and U-Butte and it's democracy of payments and governments don't know. The reality is it's used by the underworld, and that's the problem. So it will be regulated. The central banks and governments will be forced to have their own cryptocurrency. So I'm not anti-cryptocurrencies. I just don't think it's going to be Bitcoin. Yeah. And sure, it could go back up to $65,000 first, but I think in the long term, I don't buy it.
Yeah, and I guess it's fair to say, Paul, that I don't want to be elitist, but El Salvador really wasn't a big plus for Bitcoin, was it? Like if it was, say, France or Spain or even Malta, but not.
I don't think El Salvador would rate the top 5 or 10 in terms of world governance and countries that are must-have. I'm not sure that was really the biggest selling point for Bitcoin. Look, I mean, there's no doubt, that you've got people like Musk. He's a spruiker. He's classically spruiked a lot of things. I can see why there are believers and why companies are going to use it. I don't think it's going to disappear, Peter. I just don't know whether it's actually worth $34,000 US, which is at the moment, or 10,000 or 60,000. And I think that there will be central banks, as I said, and governments will be forced with their own cryptocurrency, and that'll challenge Bitcoin for its current dominance. So I just say to people, be cautious.
Certainly fund managers are starting to buy it. Financial institutions are, because their clients are asking them to buy it. And that could mean that regulation might become more important, that central banks worry about the amount of Bitcoin being held on banks' balance sheets. That's going to be an issue as well.
Sure, I'd be worried the fact that if they don't do anything, they will lose control of the monetary system, right? Because you've got to remember, if you go back to both the GFC and what's happened over the last couple of years with the COVID-19 crash, this is what's rescued the world economy. It's central banks pumping money into the world monetary system. They don't have if all currencies go to Bitcoin and crypto, and they don't have any influence over them, they can't do that again. So, and they don't want to lose control, Peter. So I just think I think the idea that this is not going to be regulated, I think people are dreaming, and the idea that somehow we aren't going to get a more, not just more controls, but less. We need, if a currency is really going to be valuable, going to be used, it's got to have. It can't be this volatile. You can't have it lose 50% in the space of a couple of months, which this has done, right? It's been going up and down 16% every day, right? So it's not there yet, I'm happy to. I'm sure I'll get some fan mail from some of the crypto bulls, but I don't buy the story yet. So
now, if you want to see the full interview, and I must admit, Paul hasn't seen the full.
No, I know I've seen the full interview, Peter, and look, there were some arguments, and I think you pretty well summarised what he's had to say.
Okay, now have a look at the podcast, and they'll be on the screen. We'll give you the link for that, and have a look at make your own opinion, and give Paul a bit of fan mail if you think he deserves it. Now, before you go, mate, today Woolworths demerged, got rid of its alcohol and gambling business under the name of Endeavour Drinks. What actually happened, Paul, that either was what you expected or surprised you?
Well, I think it was quite a surprising outcome in the market, in the sense that Endeavour traded a lot lower than people expected, and Woolworths did a lot better. And what that tells you, I guess, is just the whole ESG thing, because effectively the market at the close was valuing Endeavour at an enterprise value of about $8 billion, right? There had been some people talking about as high as $15 billion and as high as $12 billion just a few days ago.
Yeah.
So Endeavour actually looked like it was going to open about $8. Yeah. It actually came on at $6.60, sank all day, finished not off its lows, but at $6.02. Meanwhile, Woolworths only finished down $4.76. So effectively, as a result of the demerger, you know, Woolworths shareholders, and as today they've got one Woolworths share and one Endeavour share. Last night they just had a Woolworths share. They're up $1.26 on where they were yesterday, right?
Yeah,
that's the net effect, plus the fact that Woolworths has been going up into the lead up. So I think there might be a bit of a value in Endeavour. So I'm actually sort of starting to think about whether this is now a buy.
But what about your ESG considerations?
Well, I mean, look, and let's just explain.
You like a good drink and a good
gamble.
Well,
it's not the drink. I mean, I think. Well, there are obviously some people who don't like alcohol, but the problem that Endeavour has from an ESG perspective, it is through its hotels business. And remember, what Endeavour is really two separate businesses. The first is Dan Murphy's and BWS and a few other brands like Langton. So this is the old part of the Woolworths business, which has been very successful. Together with the interest that Woolworths had a joint venture in hotels, which has now got bigger. And that hotels business is the biggest owner of poker machine licenses in the country, something like about 12,000, right?
Yeah. So a lot of ethical fund managers wouldn't touch Woolworths because of that. Now that they've dropped it, Woolworths will become a popular stock.
Yeah, and Endeavour is even more exposed because it's just a alcohol and gaming business, and so it is off a lot of people's radar, and a bit like coal companies, you know? And I think that's why it traded pretty disappointingly today. And you know, it may have more downside in it, but you've got to look from a value point of view. So I think that's my other take today is to the Endeavour. There might be some value in Endeavour.
And I'm presuming you're right about this as well.
I am. And look, let's be very clear with what the usual picture with demerger is typically they struggle. The demerged company struggles for a little while because you know there's no compelling reason to buy it, right? A fund manager who's got him or her got a portfolio of assets, suddenly just because there are Endeavour shares on the market, which they couldn't buy yesterday, but they're there today, doesn't mean they have to have them, right? And so generally they're going to wait and sit back and see how it trades, and then they want to see a bit of a story, and then they need a compelling reason to buy it. Whereas there are often sellers up front simply because they don't want it anymore. They don't really want to own part of a group that has poker machines. So they suddenly have shares and they knock it off. So you tend to get more selling pressure. And that's the case with most demerged businesses. They tend to have a rough...
Well, Coles was like that, wasn't it?
Coles was like that. They struggle for the first couple of months. And then over time, the market starts to see the value. And then you start to see the benefit of... You know, one of the ideas behind the demerger is that it's usually what is an unloved or unwanted part of the empire suddenly gets set free, gets its own balance sheet, its own board, management team, you know, now don't have to get approval from head office to order paper clips, you know. They can actually make the right investment decisions.
You love that paper clip.
Well, it's sort of, if you've ever worked in a big organisation and been in part of the organisation that's sort of, you know, near the bottom of the pecking order, you understand what I mean, right? That's how big organisations work. They give capital.
That was you at Comset when it first started.
It's a bit like, we had to get it, well, we did, but we had to buy our own paper clips. But we got used to that, right? But yeah, I mean, it's how bureaucracies work, right? Yeah. And so, you know, new management team, they get control of it. They've got their own balance sheet, their own access to capital, their own ideas to explore. And over the sort of next 6 to 12 months, they start to make...
So there could be a buy over 12 months.
So putting aside the ESG concerns, the normal, you know, if you didn't have any of those in regards to Endeavour, what you'd normally expect is a soft couple of months to start with, maybe a bit, you know, and then, you know, a share price that'll go up. So I'm not rushing in to buy it just yet, Peter. But I would say it is certainly traded today a lot lower than I expected. And I guess that just brings home how big the ESG factor is.
Yeah, without a doubt. So if you want to read more about this, Paul, Rickard and the SwitzerReport.com.au. That's where you'll find it. Thanks, Paul.
Thanks, Peter.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer or click on the link in the description below. Well, joining me now is Ying Yi Ann Cheng from Coolabah Capital. And these guys, they manage my Switzer High Yield Fund. And we often catch up with Ying Yi to see what their view is on inflation and interest rates and whatever. And in the recent week, there's been a lot of controversy around interest rates, which did spook the stock market, at least for one day. Thanks for coming to the program, Ying Yi.
Thanks, Peter.
Okay, so let's just put this in context for people who don't understand. You guys manage this fund I've got, and it's called the Switzer High Yield Fund. Just explain what you invest in first, and then we'll link it to how important interest rates are to the fund.
Yeah, sure. So the Switzer High Yield Fund invests in investment grade bonds, and it can also invest in hybrids as well. However, it targets a return of RBA cash rate plus 1.5 to 3% after fees. In terms of what it can invest in, as I mentioned, investment grade bonds. So this includes, for example, senior bonds issued by the major banks, other bonds like the Tier 2 bonds that are issued by the banks as well. It can also include corporate bonds. It can include bank hybrids. However, typically what we do invest in are essentially entities that have very little intrinsic credit risk. So I can tell you now that the majority of the Switzer High Yield portfolio is actually in state government bonds. So bonds issued by New South Wales Treasury Corporation, by the Treasury Corporation of Victoria, the Queensland Treasury Corp, for example. It includes major bank bonds and also some major bank hybrids as well. So very little intrinsic credit risk.
Okay.
And cash, of course.
Okay, and so if you to work out what the return is, there's a number of things in there, but the core of it is the cash rate. So if the Reserve Bank raised the cash rate, the return would go up, and also floating bonds rates. So if for example, overall interest rates went up, the interest rate on those bonds would go up as well.
That's right. So typically people think of, bonds as being fixed rate, i.e. you lock in the yield or the coupon, but we are 100% floating, also known as zero duration. But just think that when interest rates move higher, our portfolio moves along with that. So we're not capturing it at lower rates. We're not fixed in or locked in for that.
Okay. Now every time I get you on the program, I try to squeeze out as much information as I can around what you think about inflation and interest rates. So, and also, we've seen over the last week, both the US economy and the Australian economy, they've upgraded their economic growth forecasts. I think the Yanks around 7% and we're about 5.2%. Now, did all the smarties at Coolabah expect this, or were they a little bit surprised? Gee, that's even better than what we expected.
Look, I think on the numbers that are coming out of the US and also Australia, in some ways you could see that the inflation is, can be somewhat transitory. However, no doubt post the FOMC meeting last week is that, people are expecting high rates in the US, and the market's really taken that to storm. Meanwhile, in Australia, you've got an RBA who thinks that not so much slightly differently. However, they're much more focused on, the jobs and inflation sort of numbers. So in that respect, we've spoken about it many times. What they want to see is sustainable inflation in that 2 to 3% target band. Yeah. In order to get that sustainable inflation, you need, a lift in that wage inflation number that we've been talking about as well. And that still remains quite anemic at, circa 1.5%. So we really need to get that going before anything. So in some respects, yes, it's not surprising to see that potentially, central banks are considering, unwinding some policy easing. In Australia, they're not doing anything dramatic in the sense that they're not stopping bond purchases. They are very committed to this QE or this bond purchasing program. However, De facto, we've spoken about the term funding facility. The term funding facility has meant that the banks since last year have been able to borrow off the RBA at super cheap rates of 0.1% out to 3 years. This facility ends at the end of June, which means that at the end of June, the banks will have to start issuing their own wholesale debt. And that wholesale debt or that borrowing rate will be more expensive than the 0.1% they're getting off the RBA, which means, by the way, that they're going to have to lift their mortgage rates. So in effect, by not extending that facility, you're already getting a bit of tightening in the economy, which is probably, kind of needed, especially considering the housing market.
And do you think that the raising of rates by banks will be mainly in the fixed area and that banks won't go outside the Reserve Bank's cash rate movements?
Yeah, good question. That we haven't, completely sort of, modelled as such, but I would presume that, yes, they would lift that fixed rate and they wouldn't really be adjusting that variable rate by that much, as out of cycle rate hikes vis-a-vis the RBA.
Okay. Now, apart from the fact that a lot of people, care more about stocks than they do the bond market. I'm sorry to say that, Ying Yi, but you guys just aren't as popular as the stock market. But we do know that there's a big impact that if we think interest rates are going to rise and the bond market's going to be pushing up yields, the stock market can have a negative effect. So what is your feeling about what the bond market's going to do in coming months?
Yeah, obviously I'm a bond investor, not a stock investor. However, I do think that, the markets are bracing for, I suppose, higher rates in the future, which means that if you're a traditional equity investor and you're using that discounted cash flow model, the present value of your equities based on, high interest rates is always going to be, lower. So it means lower stock prices. However, we really need to see how, inflation sort of pans out and whether, the Fed actually starts to sort of, hike rates in that respect. If we look at the RBA, so domestically, that's still going to be some way off. In fact, their guidance with respect to, there's this thing called yield curve control. The fact that they're not planning to extend that yield curve control bond from April 2024 to November 2024 suggests that the RBA is likely going to, hike rates, not until 2024. Of course, it could happen sooner, but, we're still talking about 3 years off. Okay.
So what I'm being told by my bond market experts, of which you are one, that the longer bonds are actually, the yields are coming down, the shorter ones are going up. Does that mean then, what does that message tell you about what's likely to happen to interest rates, the fact that the bond market's doing that?
Yeah, so essentially that means that the market is pricing in rate hikes sooner rather than later. And so, people thought for a long time it was going to be lower for longer, and essentially long end rates were much higher and, short end rates were much lower. Because they're now bringing that forward, that essentially means, we get this, what we call a flattening of the yield curve, which you often sort of hear. In some respects, what I would highlight again is the benefits of having a floating rate portfolio is such that if rates in the short term do move higher, you benefit from a higher yield or coupon from that particular floating rate portfolio, of which, the Switzer high yield fund is one of.
Yeah. And I guess for my way of thinking then, if the bond market is saying shorter term bond rates should go up, longer ones shouldn't, is that saying anything about, well, if there is a sustained period of rising interest rates, and let's just say select the year 2023, they start rising then, would that mean that maybe because the 10-year bonds are lower, that there'd be an expectation that if short-term rates rise for say 2 or 3 years, 2023 to 2025, probably that would lead to a stock market problem and possibly a recession. And that's why the long rates are lower. That in actual fact, they're lower because there's an expectation that eventually that would lead to a recession.
I mean, that could be one way of thinking about it, or, you know, it might not be a recession, but it just means lower growth rates slower, and therefore a more normal sort of policy rate around that sort of level in the future.
Okay. Well, I'm glad you're not a dramatist or a person who goes for the scariest scenario, Ying Yi. Thanks for joining us on the program.
No, I mean, I'm very constructive. I'm very constructive on the Australian economy.
Good. So therefore, people who invest in the stock market will be happy that you've used those words.
Hopefully so.
Okay. And let's hope you're right. Of course you will be. Thanks for joining us.